Hi guys, so this is the second video of the how to invest in the stock market video series. So in the first part we have already seen the method. In this part we'll be focusing on entry and exit with respect to stock investments. So I'll be covering up the buy and hold approach and I'll show you why it does not work for all the stocks. And then I'll move on to the Richard Wyckoff accumulation and distribution cycle for stocks through which we'll be taking entry and exit in the stocks we want to invest in. So there are some variations of Wyckoff accumulation and distribution cycle. I'll be covering those as well. So just to recap, this is where we left the last part. That is the 4 process or the 4 rules that we have to follow in order to pick stocks to invest. So the first step was that we would analyze a business and make sure it meets the criteria of high ROE, ROCE. Debt should be low and profit growth should be above 6 to 7%. Then we check for the stock cycle. We need to see whether the stock is coming out of an accumulation region. We do not want to buy stocks which are in a distribution region or in a markdown phase. The third step was to check the volatility of the stock, wherein we want to invest only in those stocks where the volatility cycle is on the way down. And the last step, of course, was to check the relative strength of the stock, which is just a means to see whether the stock is underperforming or outperforming the broader market. So in this section or this video, we are going to start with the buy and hold approach. Now this is the most common and the most well-known way to invest in stocks, wherein an investor just buys a stock and forgets about it. There is an inherent problem with this method. I'll be showing you that in coming slides. But it is also true that this particular method leads to many mega multi-baggers over next decades. This has happened in the past and this will happen in the future. But the key to this buy and hold method, where you will hold stocks for decades, is to identify a business which is extremely small as of now and which grows out to be an extremely large business in years to come. Now that is one way you can actually make buy and hold method work in favor of you. But doing this is not easy because you need to identify a business with amazing precision. You need to have sort of a visualization of what a business might be in the next few years. That is not easy to that sort of precision is not easy to achieve. But what I'll be showing is another simple method where you can actually participate in a uptrend cycle of a stock and make returns on it. See, not all stocks go on to become mega multi-baggers. There are stocks which give about 100% return, 150, 200, so on and so forth. So instead of focusing on, let's say, 1,000% return, in case you can make 3-4 trades of even, let's say, 100%, 200%, that actually matters a lot. So I'll just summarize this method. So hypothetically, let's assume that we are in for the next 40 years, that is from 2020 to 2060. I've just mapped out how, for an example's sake, how an economic cycle would move. So in a buy and hold method, what we do is, despite of a 7 to 6 years lagging cycle, which is shown here, or this is a 4 to 5 year cycle, we actually continue to hold on to stocks. Now this actually requires a tremendous amount of conviction and not everybody can do it. But yes, this is also one of the good methods in case you have good knowledge about some particular business or some stock which you want to hold for the next many decades, you can do so. So what actually happens in this multi-decade cycle is that what I've posted here is the Richard Wyckoff accumulation and distribution cycle, which I explained in the first part. So what happens is as the economic cycle is moving up, there will be some stocks which will be in accumulation region. We need to participate in those. As the economic cycle goes down, you'll find fewer and fewer stocks which will actually do well. And during those times, either you can sit on cash or participate only on those stocks which are showing this markup phase. That is, once the stock is accumulated, it starts moving up. So despite of, hypothetically, let's say these are the 40 years, what you need to aim for is these mini cycles that are playing out on the upside. We need to participate in these cycles, right? So this is our aim. A buy and hold investor would just buy a stock here and won't look at it for the next 10-20 years. Now that is also fine. That has in fact created a tremendous amount of wealth. But what we are doing is we are trying to participate in upcycle of a given set of stocks which are happening along with the economic upcycle, right? So what are the typical characteristics of mega multibaggers in the stock market? See, the number one thing is the management has to be exceptionally business oriented. They have to be very aggressive, chasing growth and profitability along with tremendous sales growth. They also need to be catering to a market which is actually growing rapidly and not in markets which are already peaking out. And of course, the business and the stock per se has to be low on debt. It has to be less volatile, as we saw in the first part. Now, along with this, the relative strength outperformance that we saw in the first part, typically the stocks which turn out to be mega multi-baggers, they actually have multi-year relative strength outperformance. That means that year on year, they kind of beat the broader market and perform well. The important question here is that how many stocks actually exhibit these particular set of characteristics. There are about 1400 to let's say 1600 stocks trading in the market. Now, how many of those actually turn out to be 1000% return stock or a 1500% return stock? That is my main question. So which is why buy and hold approach actually does not work on every stock. Each stock has its own business cycle, its own industry. And based on that inherent cycle, it will actually either turn out to be a multi-bagger or a mega multi-bagger. It's easier to see a mega multi-bagger in hindsight and make out we could have easily held that stock, but in real time actually that's difficult, which is why we need an alternate method to actually exit investments up and put our money to work in much better stocks which are actually participating in the current upcycle, right? So this is an interesting chart I wanted to share. These are the returns given by a stock, and these are the number of stocks. If you see, as the return percentage increases, let's say this is 500% returns, 750%, 1000%, the number of stocks delivering those returns actually go down, right? So what we are trying to capture is this segment, okay? That is a stock which will give you a return of about, let's say, starting from 10% to about 300% over the next 2-3 years, or let's say 4 years. That is what you need to target. If you tend to focus on this aspect, and if you're very experienced in stock markets, you can actually do that. But you can also have a diversified portfolio wherein one segment you can try to focus on these stocks, and another segment you can try to catch what is happening on a broader scale. All right. So I'll come back to this Richard Wyckoff stock cycle. I'll just explain it in a brief note for those who have not watched the first part. So the basic idea is that stock actually goes through a period of accumulation, then it breaks out, then it has a markup phase where the price moves up, then it consolidates or rather distributes and has a markdown phase where it starts moving down. Now our idea of investment is we need to get into stocks which are clearly showing a pattern of consolidation and then breaking out into a markup phase. Now we need to participate only in this phase, right? And then as we see our stock breaking down, we simply exit and put our money in some other stock which is again breaking out of the accumulation zone, right? So our entry aspect is actually very clear that we take entry at this particular region. All right. So I'll just start with an example. So what we have here is a stage 4 where the markdown phase has happened. Then price goes into a nice consolidation sideways and it breaks into a markup phase, which is stage 2. So this becomes our point of entry. This is what we are interested in. We don't want to buy a stock in this range because it's moving sideways, right? So this is a horizontal consolidation sort of accumulation which happens. There is also a V-shape pattern where once a stage 4 happens, then stage 2 actually is a vertical rise. Now those are actually difficult to time or rather trade. So I would actually ask you to focus on such stocks which form a horizontal range because these are typically low volatility stocks. Right. So take a look at this example. Now what we have here is another stock which is consolidated for a period of let's say 6 years in a tight range, and then it broke out for a stage 2. Now in case during this period you see most of our criteria meeting that we discussed in video 1, which is relative strength outperformance, good ROE, ROCE, profitability in a stock, and the stock coming out of a stage one. Now this becomes a very good buy. Why? Because fundamentals of this stock over the period of time has improved, and then it has transitioned from stage one to stage two, right? So typically such strong stocks, actually, if you see this stage, this is actually stage three where the price is forming a horizontal range. But look, we don't have a breakdown. So that means we don't have a markdown phase. What happens is the price again breaks out on the upside. So this stage three actually transitions into a stage one, right? This accumulation range. And then again, we get a entry point that is stage two. Okay. So this sort of pattern actually plays out whenever you are into a very strong company which is delivering some exceptional numbers, because breakdown never happens in the stock. It just consolidates sideways and it just moves higher. Okay. So in the current context, if you track something like an IndusInd Bank, just look at the chart of IndusInd Bank, you'll find this thing playing out since 2009, right? So I'll take you through one more entry of a particular stock. This stock is in a sideways range for about 4 years, right? And then you see that the breakout happens into a markup phase. Now this becomes a point of entry. So entry is actually pretty clear. One thing I want to add here is that whenever you spot a stock, hypothetically, let's say we are interested in taking a trade in this stock, and this is something like a Yes Bank. I'm just giving an example. So what you need to do is you need to check private sector banks, other stocks like Yes Bank, let's say IndusInd Bank, Kotak Mahindra Bank, HDFC Bank. If most of the banks are actually showing such horizontal consolidation and then breaking out, which means the sector on a broader market level is actually coming out of a stage one, that is accumulation region, and moving into markup region. Now this actually becomes a high probability investment. Why? Because not a single stock, but a basket of stocks in a particular sector is trying to move up. Now that is actually an exceptionally strong stock. So take a note of this, that whenever you want to invest in a stock, and in case you are seeing a breakout happening into stage two, make sure you check what other stocks in the similar sector are doing. In case you find 2 to 3 or let's say 4 or 5 stocks in a sector showing the same pattern of moving out of a consolidation range into a markup phase, that becomes a high probability investment and you should go after it, right? So I hope the entry part is clear. In case you have doubt about the entry part, just leave a comment below and I'll answer that particular query. So I'll just move to the exit part as of now. Now exit in investments is actually complicated. The reason why it's complicated is because you don't get to see a perfect stage 3 exit formation. Now what I mean by that is, I'll just pull up this chart. What happens is as downtrend is ending, volatility actually goes down, due to which price sort of consolidates sideways, then it breaks down, right? But when the price is moving down, volatility actually shoots up. That is why you see the probability of a range forming and then breakdown happening, that is actually very low. What usually happens is as price moves up, and in case a top of a cycle is formed, you'll just see a vertical collapse in price. Just go back in history and check it out, which is why exits in investments actually become extremely difficult, and which is why investors mostly cannot handle the exit, and they tend to hold on to those companies for n number of years. So I'll just show you here how it is easy to exit a stock in a high volatility environment as well. So because of the nature of how price moves down, that is in a volatile manner while momentum is high, that's why timing an exit actually becomes difficult. To solve this problem, what I simply do is I use a 52-week moving average on the weekly time frame, right? So let me give you an example here. So this is a stage 1 stock. The stock consolidates for a period of 3-4 years, then it moves into stage 2. If you notice the previous charts, there was no moving average on it. Now I have a 52-week moving average. So we just use the 52-week moving average as a trailing stop. In case you need to know more about what is a trailing stop, you can refer to a separate video I've done on this subject. Again, the link is posted in the description box below. So what happens is we take an entry in a stage 2, that is markup phase, and the stock moves up, right? So let me switch to the next slide. So then what you see is the stock actually breaks the 52-week moving average. Now what do you do here? Do you exit all your investments? Well, the answer is no. What you should do here is that you should just exit 50% of your investments, right? Particularly in case where a company is doing well fundamentally, it is delivering some strong results, do not exit the stock completely. Since you have taken entry somewhere here, you still make good gains, but you just exit 50% stocks at this point where it closes below 52-week moving average, and then find the relevant pivot low on a weekly time frame chart. So hypothetically, let's say we are here, the relevant pivot low is this low level, right? So you mark a line here. Okay, so you have exited 50% trade here. Now in case this price breaches this pivot level, you exit the remaining 50%. The advantage of this method is, suppose you've taken a entry at about 20 or 30 and you exit at 60, you still make about 100% on 50% position, right? But you have already exited the 50% position at about 100, which is about 2 times. So that is why you use a dual exit strategy. In the next step, I'll show why this exit strategy is also beneficial, because typically what happens is a good stock, as we discussed earlier, when it breaks down, it actually does not form a proper stage 3 breakdown and move, and it does not go into a markdown phase. What it does is actually buys a lot of time and then again forms a stage 1 here and then tries to move higher, right? So just look at this chart. So this is exceptionally strong company. It does not have a proper breakdown. It will move sideways and then it will form a prolonged stage 1 phase and then break out again. So when you see this happening, what you need to do is, remember you exited the 50% positions here, right? So what you need to do is you need to build back those 50% positions here. Okay. And then again, repeat this trailing process of 52-week moving average. So this is an extremely simple, technique I've shown. I'll just repeat. Once the stock breaks down below the 52-week moving average, exit the 50% position here and then wait and see what happens. In case the stock forms a new range and then breaks out, whatever positions you exited at this point, add it back and then trail it with either a pivot low or trail it with the moving average level, right? So this moving average actually gives us the flexibility to book out on 50% profits and then again re-enter as a strong stock forms a accumulation region and then moves up. Remember, this is a stage 3 that has become a stage 1 because there was a distribution sort of pattern happening. We did not get a valid breakdown and then price again moved up, right? So I'll take up one more example here. So this is again what we see is stage 1, then this is stage 2. We get a stage 2 here. Price moves up. We get a break below the 52-week moving average here. So what we do is simply exit the 50% position here, trail with this pivot level, right? This becomes a major pivot level for this breakdown. Then what we see is the price actually forms a stage 1 consolidation. Again, it breaks out here. So whatever 50% positions you exited here, you actually added back at this position with this pivot level as the stop loss, right? So again, you repeat this process for this stage. Again, what has happened is stock has breached below the 52-week moving average. We exit the 50% position here. Then we wait whether we get a proper breakdown or the stock again consolidates and then gives another breakout. Now, whatever positions you exited here, 50%, you again add it back here and then you again trail it. So this is a very simple method to do it. This way, what you will do is this stock has the major upcycle from 2010 to about 2012. You participated in this cycle. Then it formed a range for about 1 year. Again, you participated in this cycle. And then again, it formed a range for about a period of 3 years. And you participated by adding the remaining 50% positions here. So at any given point of time, if you see, you were always carrying at least 50% positions in a strong uptrending stock, right? So that is what our main aim is, that as a stock is performing well price wise and the fundamental parameters that I've given, in case that performance continues, always remember that odds are high that the stock will actually, after breaking down from 52-week moving average, it will form a range and again try to move up. Had this been a very weak stock, then you would have seen price actually having a vertical fall in the coming weeks, because 2013 was a negative year, 2015 was a negative year, right? And even 2016 was not a great year. So you pull out your charts now and look at all those weak companies during similar phases, and what you will see is that price has actually distinctively moved down, right? So this is why I emphasize on selecting strong sectors, strong companies, even strong on fundamentals, because the ability of a trader to ride the trend and gain more on that particular stock, the odds automatically increase. So I'll just sum up the key points for this video. This is the last video in this series, but I'll be covering up host of subjects related to risk management, position sizing, even fundamental analysis in depth, and other investment related topics that are that I have to cover. So what we need to focus on is that buy and hold strategy does not apply to all stocks. In a particular economic cycle, there are some stocks which do exceptionally well, whereas there are some stocks which do not do well. So what we need to focus on is we need to hold on to a stock as far as it is advancing into a stage 2, that is markup phase, and we need to keep on holding to that stock till it violates its 52-week moving average, or let's say you get a stage 3 breakdown, a proper breakdown, which is very rare while price moves down, right? So don't forget this point, that a strong stock will always transition from a stage 3 to a stage 1 quite often. That is from stage 3 to a stage 1 and then a markup phase. This is very common in exceptionally strong stocks, and these are the stocks which go on and tend to be mega multi-baggers in years to come. So I just hope this method of entry and exit is clear to you. In case you have any doubt regarding whatever I've shown you, just leave a comment below and I'll get back to you regarding your query. So thanks a lot for watching this video. In case you want me to cover any particular investment topic, again leave a comment below and I'll take up that topic in subsequent weeks. So thanks a lot for watching, and do get back to me in case you have any doubt.
Click on the subscribe button and bell icon to get instantly notified when a new video is uploaded. Thank you for subscribing.